Hello, viewers. Welcome to the weekly roundup of news and events in the world of economics and finance. If you are new to this channel, kindly hit the subscribe and notification button to stay abreast of our posts each week. Let's get started.
Interest rates dominated the global macro scene this week, with the U.S. Federal Reserve, the Bank of Japan, and the Bank of England deciding on rates. All three institutions held rates at current levels, but the U.S. interest rate decision gained more traction as the decision held based on a 9-3 votes and the lack of a clear forward guidance statement on how the Fed would bring inflation lower sent the 30-year bond yield racing to above 5.23%, its highest level since 2007. Markets are reacting because of Kevin Warsh's lack of a clear communication, which means their portfolio real yield could remain under pressures as the Fed could react to inflation later than appropriate. Latest data on China's industrial profit and factory activity reported a slump. For context, profits at China's industrial firms grew at a solid, though slower pace as resilient exports helped cushion sluggish domestic demand, highlighting the economy's uneven recovery despite policymakers' efforts to spur consumption. Likewise, China's factory activity unexpectedly contracted for the first time in 5 months, and construction slumped to the lowest since the start of the COVID-19 pandemic, pointing to a further loss of momentum in the economy after a slowdown last quarter. The recent disconnect between the Conference Board Consumer Confidence Index, which fell 1.4 points to 90.8 in July, and the University of Michigan Consumer Sentiment Index, which jumped nearly 12% month over month to a final print of 55.2, underscores a critical divergence between current economic realities and future inflation expectations. This divergence occurs because the Conference Board survey focuses heavily on the immediate labor market, reflecting real-time consumer anxiety over slowing job growth and cooling wage hikes, as its present situation index dropped 3.6 points to 1.4.9. In contrast, the University of Michigan survey is highly sensitive to price inflation, meaning that a July drop in average gasoline prices to $3.95 per gallon and easing year-ahead inflation expectations to 4.2% helped bolster overall consumer sentiment. The U.S. Bureau of Economic Analysis released its advance estimate showing that U.S. real GDP grew at an annualized rate of 1.5% in Q2 2026, down from the 2.1% pace recorded in the first quarter, and missing Wall Street forecasts of 2.1%. This deceleration was primarily caused by data distortions, as a widening trade deficit subtracted a significant 1.01 percentage points from headline growth, and a reduction in the Strategic Petroleum Reserve drove a drop in federal government spending. Despite the slower headline rate, the report highlighted robust domestic demand, fueled by an acceleration in consumer spending. This week, the Bab el-Mandeb Strait became a central flashpoint in the regional war, culminating in Saudi Arabia announcing a 14-nation maritime defense coalition on Thursday to secure the waterway. The escalation followed severe disruptions from the Iran-aligned Houthi militia, who deployed drones and missiles along the strait to enforce a naval blockade against Saudi maritime traffic, hitting major oil tankers like the Ancelia earlier in the cycle. The bond and energy markets reacted sharply as the threat of a partial choke at Bab el-Mandeb, coinciding with the ongoing closure of the Strait of Hormuz, threatens to sever alternative routes for Saudi oil exports and trigger a global energy crisis. Germany has undergone a major strategic shift, with officials in Chancellor Friedrich Merz's government quietly mapping out China's economic vulnerabilities and trade weak points to build leverage ahead of a potential full-scale trade war with the European Union. This defensive inventory follows Beijing's late July retaliatory export controls on 14 EU firms, including German defense manufacturer Rheinmetall, which restricted critical dual-use items like rare earth elements and battery refining materials. By shifting away from its historical stance of non-confrontation, Berlin is cataloging specific industrial sectors where China still relies heavily on specialized European technology, effectively creating an economic insurance policy. Prime Minister Mark Carney firmly rejected calls to weaponize Canada's natural resources against the United States this week, dismissing proposals to curb oil, gas, or electricity exports to leverage trade talks. The debate ignited after President Trump signed a proclamation under Section 338 of the Tariff Act to impose severe 50% tariffs on roughly $20 billion in Canadian imports, including automotive, dairy, and alcohol sectors, effective August 19. While provincial leaders like Ontario Premier Doug Ford urged Ottawa to cut off energy and potash shipments to make Americans feel the pain, Carney countered that maintaining Canada's global reputation as a trustworthy, reliable supplier is paramount. On Thursday, the Japanese Ministry of Finance executed a massive, surprise foreign exchange intervention, selling an estimated $53 billion to $59 billion to abruptly buy back the yen after it plummeted to a fresh 40-year low near 164 yen against the US dollar. Triggered in New York trading hours ahead of the Bank of Japan's Friday policy meeting, the aggressive yen-buying operation caused the currency to spike by over 3.3%, rapidly strengthening from $162.80 down to the $157 mark in less than an hour. Andy Burnham says he would give mayors in England a share of the income tax generated in their regions as part of the new UK Prime Minister's drive to move political and economic power out of Whitehall. This groundbreaking fiscal proposal by newly appointed Prime Minister Andy Burnham directly delivers on the medium-term strategy of regional economic decentralization by giving England's metro mayors a direct financial stake in local growth. The geopolitical deadlock in the Middle East continued this week when Iran's newly formed Persian Gulf Strait Authority officially declared that transit through the Strait of Hormuz is not possible due to ongoing U.S. military blockades, effectively cutting off one of the world's most vital energy choke points. The closure followed a dramatic escalation on Friday when Iran's Islamic Revolutionary Guard Corps, IRGC, launched strikes that hit and halted 2 commercial tankers attempting to pass through the waterway via an unauthorized route under U.S. military aerial escort, while forcing 4 other vessels to turn back. That's all we have for this week. Thanks for watching, and remember to like, share, and subscribe to this channel. See you next week.